Hello, everybody, and welcome to our second SFR Talk event. This is being brought to you by HomeRiver Group. So thank you for being here. Glad to see everybody here. Today, we're going to talk about creative financing solutions for investors. Again, if you got any questions, please submit them anytime in the Q&A feature of the Zoom call, which is down at the bottom of your toolbar there. Looks like there's already two questions in there. I haven't snuck a peek at what they are yet, but it looks like there's two in there. So again, thank you for joining. HomeRiver Group is the nation's leading property management company. We have around 26,000 properties under management as of today. We specialize in all type of property management, whether it's multifamily, institutional, or the folks that just own one or two. So we are really glad that you're here today. Looking forward to having this conversation. So let's get right into it. We got a tight time frame today. So Scott, next slide, please. So today's speakers are myself. I'm Scott Heimel. I am the Senior Vice President of Sales and Operations here at HomeRiver Group. I have been in the property management business for roughly 27 years now. I've been an investor myself. I've owned many rental properties at some point in time in my life. Mostly all gone today. I think still got one lingering around somewhere. But love this business, been in it forever. When I first started in this business, said this is the place for me. So glad to be your host today. We got a great speaker lined up for you today. And his name is Mark, and I'll let Mark go ahead and introduce himself and what he does.
Okay, thank you, Scott, and thanks to HomeRiver Group for having me today. My name is Mark Maimon. I am a 22-year veteran of the mortgage industry and an avid investor. So I've kept all my properties, have not yet sold other than to trade up. But I'm right in it with all the members of the audience today. I'm diving in, I'm converting buildings, adding units, trying to build a portfolio and create that legacy for my family that hopefully will last longer than I will. But I appreciate the opportunity to come in and talk about financing today.
Great. Thanks, Mark. Appreciate the introduction. So, with today, it's really challenging, right? Home prices are up. Mortgage rates have been historically up. They now have come down. So, hopefully, we'll get some pricing out there in the real estate market that will help accompany that. But, what are you seeing with that? Are you excited about the rate drop? What does that bring for our investors?
Yeah, I think in general, interest rates coming down is a very good thing. It helps with cash flow. It makes deals more viable that otherwise might not be. And it's been tough with prices being high and interest rates high at the same time. It's been tougher to source good investments. But one common misconception that people often have is that the Fed just dropped rates by 0.5%. So that means consumer rates are down 0.5%. That's not quite how it works. The federal funds rate is a completely different interest rate than consumer rates, although they do tend to move in the same direction generally. But the market actually prices those changes in before the Fed actually takes action based on what the Fed is expected to do. So the main consensus was that they were going to drop it by 0.5%, which is exactly what they did. So on the date of the actual announcement, the rates didn't move at all, but they had moved 30 to 60 days prior slowly in a downward direction. So we're moving in the right direction, which is good. Interest rates are likely to continue to fall. Prices in some markets have softened a little bit. So I think it actually opens up a great window of opportunity for an investor to jump in before rates hit a new bottom. And then all of a sudden you're competing with 20 owner occupants who want to buy the same property. So there's definitely a good window of opportunity right now.
Yeah, it's a great point and great information. Everybody gets excited when they see the announcement. So, but it's good to know that it's already happening, and hopefully we'll continue to see those rates continue to come down. It'll only help our market together. So, again, with the tight market and home purchase prices where they are, if I find a home out there, maybe it needs a substantial amount of work, and I'm looking to get that done. What are the options out there for financing that I can do to purchase that home, or try to limit the amount of funds that are out of my pocket to do that as well?
Sure. Well, So one of the beauties of investing in real estate is leverage. And I don't say that only because I do it for a living, but because I leverage my properties as much as I reasonably can and should based on a number of different factors. But oftentimes investors don't only own one property. If they do, if they find a good deal, in all likelihood, they'd want to do another if it's a good investment. So one way to pull out equity is to, take out a cash out refi. There's lots of different products. There's HELOCs, and every client situation is completely unique because some people have a 3% mortgage that they don't want to get rid of. So that might be a different solution than somebody who's sitting at 8%, as far as whether you would replace that mortgage or not. So there's a lot of different products out there. What we usually do to decide what the right recommendation is we look at what that existing mortgage looks like and if it makes sense to pay it off or not. And looking at different alternatives. And then if the property needs substantial renovation, it might require construction financing, and there's different variations of that. But construction financing is a great way to add value and equity, sweat equity in a home. And so I'm halfway through that type of project myself, and I think there is value in that. It definitely gets a little more complicated and more expensive to do that. But the deals right now, the ones, in my opinion, you're going to find the best opportunities on are ones where maybe an owner occupant doesn't want to come in and do the work that you might be willing to do as an investor, and you can create sweat equity by doing it. So if you have the stomach for it, that might be something worth considering. But there's lots of different ways to finance. It really depends on how you do it. One other thing I want to point out is that one of the beauties of financing for investors as opposed to owner occupants is that the regulatory environment is far less strict for investors than it is for homeowners. I think they want to, the government wants to protect people from losing their own individual homes. But if an investor loses their home theoretically and as an investment, maybe the government doesn't quite care as much about that. It's a business decision. So what that means is that there are products that are out there for investors that don't require traditional income verification. They allow for things that owner-occupied loans don't allow for. And we can get into those in a little more detail if you'd like. But there's some great products out there specifically for investors to take advantage of.
Yeah, and that's it was actually going to lead right into that next question. In your opinion, right now, looking at the different type of packages that are out there, what seems to be the most appealing? What are investors actually choosing for their financing? Again, my very first home I had bought many years ago, 20 something years ago. I had a great deal. They would give me 80% of their appraised value subject to the home's completion. So I had the funds to actually get the home ready for rent. And, it was just a regular mortgage. It wasn't even a construction note. Obviously, those days are long gone.
Yeah, that's changed.
Yeah, that's changed. So, as somebody who, started off with very little cash and didn't want to come out of pocket, what is similar to that, or what are the best, kind of finance options out there today? If I'm either looking to add another property to my portfolio, or maybe get some leverage out of my existing portfolio. Maybe I had a bad turn, a bad tenant. I had to turn the home quickly, but I didn't, have $5,000-6,000 laying around. So I know there's like 4 questions in there, but I'll let you pick and choose which ones you want to answer.
Sure. Yeah, I'll get to those. But as far as like some great products that we utilize often for investors, one, let's just assume a property doesn't need major renovation where you need a construction loan. We'll get into construction financing as the second one. But one of my favorite products is something called a DSCR loan. So debt service coverage ratio is the acronym there. And what that loan is, and the reason I love it, is because investors, if you're doing this as a profession or on the side, oftentimes the tax returns are, the tax code is very friendly to investors, let's be honest. So oftentimes the tax returns don't look great as far as qualifying for conventional financing. So a lot of times, if you're an owner occupant, you'd be kind of out of luck. If you want to buy another property and you don't qualify conventionally, there are some creative products, but not nearly as creative as there are for investors. So the beauty of the DSCR loan is that the loan is the approval, with the exception of, having to meet minimum credit requirements and having a little bit of money left over after closing in a reserve. The beauty of it is that the underwriting is primarily based on the cash flow of that property in a vacuum. So if you have cash flow, let's say you're renting for $2,000 a month, and your expenses for your mortgage, taxes, and insurance are $2,000 a month as well, and you have decent credit score and a little bit of money in the bank, those loans are going to get approved. It doesn't matter if you have 10 other properties that are all losing money, or if you have if you're retired or are in between jobs or anything like that. They're not looking at employment and traditional income. They're just looking at the cash flow of that subject property by itself. So it doesn't matter what the rest of your finances look like, and if you can qualify more conventionally on what we call a debt to income ratio, which is your income relative to your personal expenses, that's not a factor in these loans. So that's one where you can pull equity out. You can use it to acquire properties. Generally speaking, you can get up to the best rates tend to be with 25% down, but you can go up to 80 and sometimes a little further. But as you go higher, you get higher in rates. So you have to be a little mindful of that. But that's one of my favorite products. Now, in the event you find a property, let's just say it's uninhabitable or it needs a lot of work that you don't want to come out of pocket for, there are what we call fix and flip or fix to rent loans, where basically you build in the majority of the construction costs into the loan. And what the lender will do is they'll build out what we call a draw schedule, which says, okay, once you finish, let's just say it's a major project, you finish framing, they'll give you $20,000 reimbursement for that. And then you finish rough plumbing and they'll give you $10,000 for that. And it's kind of predetermined what schedule they're going to reimburse you for. So you might have to front the money, but then you get it back within a handful of days. So, and those usually don't require nearly as much capital as you might think. Some of the more aggressive programs will finance up to 90% of the acquisition cost and then 100% of the construction cost. So you can really leverage it if you want to. They will do that only if the property value in the future is high enough to justify the amount of financing you'll have long term. So there are some considerations there, but it's a great way to rehab a project. And in my opinion, the rehab is where you can build some sweat equity and really take advantage of market conditions, where a homeowner might not want to buy a house that's uninhabitable and needs $100,000 worth of work, but investors sometimes love those projects.
Yeah, those were my favorite, to be honest with you, in my younger investment days, because I would go in there and do a lot of work and enjoyed those. And apologize if everybody hears my dogs barking in the background. There's squirrels running around, so I apologize if I have some background noise. So let's talk a little bit about the DSCR. I got a couple questions around that, just to help maybe get some clarity to everybody attending this call. Can you do that with multiple properties? And is this a newer program, or has it been around for a while, and did it replace something? So it sounds really interesting, and a great tool for our investors to be able to use. So just if you could touch on that, that would be great.
Yeah, it's basically a commercial application to residential properties. So this is generally how commercial loans are underwritten, based on cash flow. And commercial would be anything more than 4 units. But now it applies to residential. So I think what happened was, how my industry often reacts to a need is they see investors struggling to get financing. So they try to come up with creative products to facilitate and overcome those common challenges, which is oftentimes documentable income being sufficient to carry all this. So these products are not brand new, but they're relatively new to the market and kind of came out of a need, of just lenders seeing a window of opportunity to, try to find new creative ways to lend people money in a reasonable and safe manner. And so they become very popular, and there are no limits on how many of these loans you can get, which is also one of the beauties of it. They also let you hold title in LLCs and things like that, that some conventional loans don't allow for. There may be a prepayment penalty on them, but you can shorten that. So there's some things to kind of work through to make sure that we structure the loan in the right way for each client. But they're not brand new, but they're relatively new, and they're becoming very popular with investors for obvious reasons.
Yeah, I understand why. I'd probably be a little nervous of the prepayment penalty, but I guess if that's somewhat negotiable, then it's not a bad thing, depending on
It
what
is.
your long and short-term strategies are for that property, right? So it may
Exactly. And
not be
also
the
being mindful of the fact that rates are likely to continue coming down. So for our clients that are taking these types of loans, what the options that you have is you can take a slightly higher interest rate, let's say 0.25% higher interest rate in exchange for shortening the duration of the prepayment penalty. You can completely buy it out, so there is no penalty, but we're usually telling our clients in the current environment, have it be no more than 1 to 2 years max, because you're likely going to refi out of this loan within a couple of years.
Yeah, makes sense. So thanks for that. That was very informative. So
Yeah.
let's talk a little bit, and we don't have a ton of time on this call. I want to make sure that we get to the questions. That's the most important part to me of
Sure.
this call, is trying to give answers and information out to our clients and our investors. So let's just talk about I've heard this a lot. Well, hey, I got a great interest rate today. I'm sitting at 3%, and rates are sitting at 8, and I don't want to give that up to either go purchase another property or to pull some equity out to maybe put a roof on it. And excuse me. And what you end up seeing is a home that might sit there a little bit longer because not wanting to come out of the pocket. Now I have other things around that of, well, hey, your vacancy loss doesn't equal the time to sit because there's no funds to fix that. So to me, it would almost be worth it to either finance that out, or you shouldn't slow down growth. If you have the opportunity, you should always be growing. So but those are two personal philosophies I look at. So so tell me about that kind of that scenario where somebody's at that great interest rate, and rates today are higher. When should they, when shouldn't they? So tell us
Yeah.
about that.
So what we usually do is we run a blended rate analysis. So we look at a couple different options. One is you leave that rate in place, and that mortgage in place, and then you do a second mortgage or a HELOC, or one, there's different forms of that for investors. There's fixed rate second mortgages and HELOCs. That oftentimes makes sense if you have a larger primary mortgage than the amount that you're looking to take out on a second mortgage. So let's say you have a $300,000 mortgage and you need $50,000 to $100,000 to do some repairs, or just have on hand for unexpected expenses. In that case, if you're at 3%, you're probably not going to want to replace that 3% mortgage. If you've got a $50,000 existing balance at 3% and you need $300,000 to do your next project, or strategically just makes sense to have access to some of that equity, now it's not so bad if you pay off that 50,000 at 3%. The blended rate is probably going to be better if you're in, let's say a DSCR loan is in the high sixes right now. So the rates are not bad. Considering current market rates are somewhere in the neighborhood of like low sixes for low to mid sixes for an investment property for more conventional underwrite. So it's actually not that much of a difference. So we look at that blended rate between both of those two options, either replacing the mortgage with one larger one that may be at, let's say, 6.5%, 7%, versus keeping the mortgage amount that you have and then cashing out on a second mortgage, and we see which one makes the most sense.
Yeah, great. So thanks for that. So last thing, and then we'll jump right into Q&A. Again, want to make sure we have enough time that we can answer folks' questions. So saving and raising capital. And these are just some of the notes that I wrote down. I feel that everybody would benefit from. But saving and raising capital for investments or improvements to a home. What's your thoughts around that, and how can somebody get ahead of the game on that? It's always tough to raise capital.
It is.
And we're all searching for that thing. And I guess it kind of ties into what we just talked about in a way, right? Where you got your second mortgage or maybe you refinance that out. So we may be regurgitating that, but I find that our clients really always need access for capital or for turns and that all that good stuff. So
Yeah.
again, everybody's situation is going to be a little different, right? But what are you seeing the most that folks are doing in the market for investment to actually get capital? Is it that second? Is it a HELOC? Like what are you seeing them?
Yeah, it's a combination. I would say second mortgages are definitely more popular now because people are at lower interest rates most of the time than what's available currently. So second mortgages are really popular, but they have their downsides as well because they're higher interest rates, and they're variable. So they may go down for a period of time, they may go up for a period of time. They're a little less predictable if they're prime based. But I think one thing that investors always need to keep in mind is that the return on equity in the property, guess what? It's $0. You get no benefit if you have a lot of equity sitting in your home and you're not putting it to use. So what, any investor would do is an analysis to figure out like, okay, what if I pull that money out? Yes, maybe I'm borrowing it at 7%, for example, but if it means I can do another project and have another long-term investment and the rent is covering it, it may be worth it. It may not, but that's the analysis that you need to do. And as rates come down, that math looks better. And in all likelihood, what we're talking to clients about is your cash flow might not look amazing now, but if you get the property now, you may get it at a lower price than what you might get when rates are at a new bottom. So let's say they get to 5%, 4.5%, if we're lucky, over the next couple of years. When that happens, in my opinion, you're going to have a rush of buyers coming in, probably more so than sellers, in part because when somebody sells, oftentimes they're looking to buy something else, so it doesn't really change the market. But a lot of buyers are sitting on the fence right now, not competing with you for properties. I think there's actually a window of opportunity right now to take advantage of that, but you have different ways that you can pull the equity out. So the other thing is that, over the past 3 to 5 years, the amount of equity people have in their properties has grown significantly because property values have gone up in general pretty rapidly. So you want to take advantage of that while you can in a responsible way. You don't want to over leverage yourself, but there's more equity in people's properties than there's probably ever been. And the return on letting that equity just sit is zero. So if you can find a way to put that money to use, that's a great way to do it. As far as managing turns, I'm a big fan of always having access to cash, even if I don't need it. So I have lines of credit on my properties that I can tap into if, a tenant breaks something and moves out, or they're not paying rent or whatever. There's always somewhere where I can pull cash from that I don't have to use my own capital to solve those problems. So one of the best executions for managing turns is to have a line of credit open, even if you're not going to use it immediately, to be able to pull funds from in the event that you need something unexpectedly. Because we kind of know what's going on in our investment properties and what our tenants are doing, but every once in a while they throw a wrench at us, maybe literally, and might put a hole in the wall that needs to get fixed. So having access to that cash is really, really critical to being able to manage those unexpected events.
Yeah, for sure. So thanks for that. I like the line of credit thought. It's good to have, funds available when you need them. I've used them, many times in my career. You know, I have a significant other, my wife, who says, "Hey, I don't want to use our cash for this. Can you find another way to finance it?" So it helps me get over that hurdle as well. So,
Right. That
all
really
right.
expensive
So
purse.
yeah, that's
Gotta
right.
finance it.
So let's get right into it, Scott. If we can go to Q&A, looks like we got 21 questions in there, so this should be
Great.
amazing. And Scott, take it away.
Yeah, thank you everybody for all the questions. This is awesome. We're going to get to as many as we can. Keep submitting them, and we're going to do the best we got. So this is from Monica. She asks, I'm interested in finding out how to obtain financing if I own an LLC.
Sounds good. Okay, so most DSCR loans will require a personal guarantee. So you're still signing on the loan, but usually the title, in many cases, the title is held in an LLC. So there are loan programs, most of the DSCR programs and others that allow for title to remain in the LLC. Some more conventional lending options like Fannie Mae, Freddie Mac, they do not allow you to close in an LLC. So if you want to refinance or cash equity out, you would actually have to remove the property from the LLC held title, but they also allow you to put it in an LLC after Fannie Mae takes ownership of the loan, which is usually like 30 to 60 days later. So there's some creative footwork you can do to bounce around that if you need to. But in general, investor financing is savvy to the fact that most investors are holding properties in an LLC and they allow for that.
Great.
Next question is from Mo. As a non-American citizen, how easy is it for one to take out an equity on a property that they own outright in Tampa, Florida?
Sure.
What are the processes involved in doing so?
Yeah, it's a very common request. We work with a lot of foreign investors. So depends, Mo, on what your status is, if you earn income in the US or not. But in general, the DSCR loans are available for non-American citizens. If you have a visa, a green card, work authorization, generally speaking, you're going to get better rates than if you're a true foreign national who lives and works overseas and has no real connection to the US other than investing in real estate. But there are options for the full spectrum of immigration status.
Patty asks, for free and clear properties that need a lot of work, should we use our own money to rehab and then take an equity loan on it? Once the property is free and clear, a mortgage cannot be put on it, correct?
No, you can absolutely put a mortgage on it when it's free and clear. The beauty of it being free and clear from my perspective is that there's no 3% mortgage rate that we have to be mindful of. So in that case, Patty, I would probably suggest a primary mortgage. If you have a pretty good sense of how much money you need to rehab the property, you're going to get a better rate on a primary mortgage than a line of credit. Or maybe it's a combination. Maybe you do half of it on each. I don't know. It depends on your circumstances. But you have the advantage of being able to take out a first mortgage without losing out on a 3% rate that other people might have if they have an existing mortgage. So you can definitely pull money out on free and clear properties. Again, the concept of having 0% rate of return on that equity, you can definitely put that to use and grow your portfolio.
Yeah. So, Mark, I actually saw a really good question in there, and it's on my list, but I was so excited to get the Q&A that I did not ask you. But I see it in the chat, and sorry, Scott, I know you're running Q&A, but I was just cruising through the questions here. So, does the DSCR loans require any specific improvements, like updated wiring or things like that? And then in addition, so does it require any updates, or do they come and do an inspection and say, hey, you got fuses in here, you need to upgrade that before we do the mortgage, etc.?
Generally, no. It's the same type of appraisal as you would get if you were buying a primary residence. The only difference is the appraiser is also going to comment on market rents. So for example, if you have leases, I'll put leases in quotes, that show $4,000 a month for each unit, but the market rent is only $1,000, that might be something that they question. So but no, they're not doing an inspection on the property as long as there's nothing that is evident on the surface. When an appraiser walks through and visually looks at the property, like if there's exposed wiring or drywall missing or something like that, that's something that they would call out and require to be fixed prior to closing. But for the most part, as long as electrical is operational and plumbing is working, and they'll check the gas to make sure it's on and functional and all that. But if you have a tenant in there, I would imagine those are not issues anyway. So yeah, generally, no, there's no formal inspection done.
Thanks. Back to you, Scott.
And thank you, Charles, for that DSCR question. Kim asks, I have similar responses you've given in the past. I have 2 properties that are paid off. How do I leverage these? I find it's hard to find a lender who will give money for an investment property.
Well, great question, Kim. Maybe you're just calling the wrong lender. So depending on your circumstances, which obviously we're not going to get into on this call, personal finances and whatnot, we could have a discussion and help you figure out the best way to do it. If it needs to be a DSCR loan, if you have no existing loan, maybe we could do a traditional mortgage on it for investment properties, because you can do cash out refinances on investments, maybe a HELOC. Obviously, we'd have to look at your specific circumstances to determine which product is right, but there's nothing prohibiting you from pulling that equity out and using it in any way you want, whether it be to invest in other properties, to invest in repairs, whatever it is, to go buy Scott's wife that nice new purse, if you're so inclined. You can do as you wish with those funds.
Another question. What are low down payment options for investment properties?
Sure. So I think one of the things that lenders try to do is mitigate risk. So especially when you're talking about a loan that requires less documentation, like a DSCR loan, they generally want to see that you've got 20% down. Now, there's ways to pull that down payment from another property if you own something else. So there's some creative solutions you can do to actually not have to come out of pocket for them. I now own 10 properties. I'm not using any of my own funds when I buy another one. It's all being pulled from equity and others to try to grow the portfolio and use leverage. But in general, a DSCR loan, usually the minimum down payment is 20%, but that 20% can come from a myriad of sources. It could come from another investor that maybe you co-invest with. It could come from cash out proceeds of another property, where you close on a cash out refi or a HELOC before you close on that purchase. So there's lots of different ways to do it. If you're looking at a Fannie Mae loan, if you're buying a single family property, I believe the minimum down payment is 15%. Anything less than that is going to be difficult. It's not the same as owner occupied residential where you could put down, 3%, 5%, things like that. You really need to have a larger down payment, but there's different options for where you can pull that down payment from.
We have another DSCR question.
Sure.
Do banks usually give out DSCR loans? It seems that most of the lenders that accommodate DSCR are online nationwide lenders that seem more like private money than institutional lending. What are some lenders that we could look for DSCR loans?
Sure. So what I can tell you is usually those are handled through the mortgage brokerage community. So we're a functioning mortgage brokerage. If you want to give us a call about that, we'd be happy to talk with you about it. Obviously, we're very familiar with how these work. But you're not going to find these from your big retail banks from around the country. I probably shouldn't mention them by name, but all the big banks that you see many branches for around town, they don't do this type of lending. Especially on residential 1 to 4 unit properties. So you'll be barking up the wrong tree. And you made a great observation that they don't provide those types of loans, which is 100% correct. So it's usually small regional lenders that do what we call it's called non-QM lending. So I won't get into too much detail, but non-QM stands for non-qualified mortgage, which is basically a qualified mortgage, basically a Fannie Mae owner-occupied loan. Anything outside of that is considered non-QM, other than jumbo loans that require traditional underwriting. But without getting too technical, these loans are not offered through retail banks.
Another one. If someone puts together financing for a deal from partners, what additional equity or other compensation does the person leading the deal usually take? What is a customary range for this?
Ooh, that's a tough one. What the question really is about syndication, which is probably, I don't want to overstep my role as a lender. But what I've seen on other syndicated deals depends on the size of the syndication and how many people are involved. But I've seen a range of anywhere between 5% and 25%, depending on what people are doing to earn that management fee.
Okay, trying to fly through these. Lots of questions. Thank you, everyone, for all of these. Does it make sense to establish an LLC for purchasing investment properties? And if yes, what do banks require for approvals?
I can touch on that a little bit.
Yeah, please.
You can go on the financing side. I personally believe it does. You don't have to, but just remember, in today's world, your name's on that. An LLC at least protects you a little bit from potential liabilities. I'm not saying everything, but it does give you a little shielded protection from your personal assets should something happen, to slip and fall, or something catastrophic happen at the property. It's not perfect, but it gives you a little bit of protection. To me, that seems like an attorney question on asking whether an LLC is right for you. I will tell you that my personal properties were all in an LLC name. It made it easier for me to kind of keep the two finances separate, which was important to me as an investor. So it really depends on your tolerance as an investor. As far as financing options, Mark, I'll let you answer that.
Yeah, it makes it incrementally a little bit more difficult to do financing, but not in any noticeable, tangible way. The only reason I say that is because if you have your property in an LLC, for example, Fannie Mae and Freddie Mac loans are out. They're not an option. So there's less of a pool of potential lending solutions when you have the loans in an LLC. But if it's an investment property and you're comfortable with DSCR loans, you can do it all day long. So, they'll look at the, formation documents of an LLC, an underwriter will, to make sure that there's nothing in there out of the ordinary. But most LLCs are pretty standard. They indicate that you can own the property in LLC and operate it. They mention who the members are, things like that. So in general, it's not a major issue.
Yeah, so just a heads up for everybody, we have about 5 minutes left, so we're going to try to get through as many questions as we possibly can here. So Scott, let's go with the next one.
Okay, speed round, huh? Does construction financing cover technology related improvements like installing an AI-based HVAC optimization tool?
They can, yes. There's no restrictions on that, but what a lender is looking at is what the future value of that property would be. And the appraiser gets to determine if that AI type of HVAC system is actually going to add value to the home other than just functionality and maybe remote control of it or whatever it may be that you're looking for with that. So it's not prohibited, but I don't know that it will the added cost may not show up in the added value of the home.
Charles asks, and Scott, this is for HomeRiver Group, is HomeRiver Group have a cheat sheet or Excel file that contains formula to help investors determine if a property is worth investing?
Yeah, it's a great question, and we have one behind the scenes that is actually public and online. Happy to send you that link, but again, everybody's investment goals are a little bit different, so the cheat sheets need to kind of be manipulated to fit in to what your investment strategy is. Some investors are long hold, some are short, some are mid. So it really depends on what your overall investment strategy is. If it's buy and hold, are you saving for retirement? Are you looking for cash flow today? Are you looking for, hey, I just want to hold this for 3 years. I know the market's got a higher appreciation rate right now, and I'm going to cash out in 3 years. So all of those things play a part when you start to look at, hey, what does this mean for me in the long run? So getting one sheet to kind of fit all of those buckets is really tough, but we do have a sheet online. We'll be happy to send it to you.
Mark, what states can you lend in?
There's 21 of them, so there's too many to list. But we'll be sending out some materials after the call to everyone where we'll list out all of the states. But we have states all across the country, a total of 21 of them.
Okay, here's another question. I have one property at 3.25%. and I have a conventional loan. I'm probably not going to let that rate go, but if rates do come down, could I swap to a DSCR as a cash out refi?
Absolutely. Yeah. I mean, I'm going through that same dilemma myself right now in one of my properties that has built up some equity. I added an ADU to it, which is a topic we can talk about on another SFR talk another day. But it's got equity, but I'm torn because I have that low rate. So I'm actually looking into second mortgage options to pull equity out for myself, because I'm, like I said, I'm in the same boat as everybody else on this call, having these same conundrums and decisions to make. So yeah, the short answer is yes, you can absolutely do that when you feel that the spread between your 3.25% and whatever a DSCR loan is at, which is probably never going to be 3.25%. But if the spread is good enough to justify you being able to do your next deal, then yeah, you absolutely can do that.
I see we're at the 40-minute mark. Do we want to continue with Q&A?
Yeah, let's do a couple
questions.
Let's do a couple more, Scott.
Okay.
We'll give it 5 more minutes.
Do you have a program where I want to leverage 60% and 40% private equity for multifamily?
Yes. Since we only have 5 minutes, let's just say yes.
Yeah. Can I take a second mortgage on my properties if they are owned by LLC?
Yes. Look, more limited options, but yes, absolutely.
Okay. This person asks as a new investor, if I have $50,000 equity in my property, would a second mortgage usually be just for that 50,000?
Well, you can't leverage 100% of the equity that you have. A lender's always going to want you to maintain usually about 20% equity. So if you own, let's just use round numbers, $1 million home, you're never going to be able to leverage more than probably 80% of that, or 800,000. And that includes your existing mortgage and any second mortgage you put in place on it. So if you have 50,000 of total equity, you're probably not going to be able to pull out nearly that much.
Where do you recommend going for lines of credit on rental properties?
I mean, we work with that. Again, these are oftentimes done through the mortgage brokerage channel. So we have relationships with companies that offer these products. Because we work so much with investors, we've specifically gone after the market to pull these products in so that we can offer them to our clients. So there are, again, you're not going to get them from traditional banks. They're not going to do a second mortgage on an investment property. So it's usually, again, through the mortgage brokerage channel where we have access to a lot of different products from a lot of different sources that you'll be able to source those types of loans.
Yeah, I think that's an important comment. We'll call them big box for now, you know, or pretty cookie cutter with their services. So if you're trying to get creative with your financing, you're going to have to go to more of a mortgage broker than what you would out of the cookie cutter type of loans, because they just don't offer them. It's tough for them to do that when they're trying to be standard across, you know, many markets. We run into that at HRG. We want a really standard service in our management practice. And it's hard when you start having different variations of your service everywhere. Things can get really mixed up, and you end up falling behind on certain things because they're hard to track and keep attention to. So next, Scott.
Back to DSCR loans. Can the down payment be gifted?
With some programs, yes, some no. But if we know going in that that's where the money is coming from, then we can specifically target the lending programs that allow for it. And it's a great question, because oftentimes with investment properties, gifting is not allowed. Like on a Fannie Mae loan for an investment property, jumbo loans generally not allowed any gifts whatsoever. So that's a great question.
Yeah, I like this one. What are the pros and cons of conventional loans through a retail bank, or maybe a big box bank?
If it's conventional, that usually means it's Fannie Mae, Freddie Mac, you know, government-backed loans. Generally, those are going to be exactly the same no matter where you get them, because the product is actually Fannie Mae's product. Each lender is kind of a shell for Fannie Mae on those types of loans. So even if you shop it with 10 different lenders, you're going to pretty much get the same terms with every single one of them, because it's really Fannie Mae that's driving the base rates. And every lender over the course of many years has kind of established what sort of margin they want to have on top of that. without getting too technical, and no one's going to offer a substantially higher rate on exactly the same product. So usually you find pretty much every lender is going to be basically the same. So it doesn't matter if you go through a retail bank, a mortgage broker, a lender like us, which is a direct lender and a mortgage broker all in one. You're pretty much going to find the same terms on conventional no matter where you look.
What types of, James asked, what types of loans do you see as a lender to be the easiest to obtain for clients who are just getting into real estate investment?
DSCR is beautiful. I mean, if you don't want to have to document income, you want to be able to close fast, the less paperwork you have to put in front of an underwriter, the faster the transaction's generally going to move, because there's less to review. So DSCR loans are a great way to get started. If you have traditional income and you're able to qualify for a conventional loan, we might recommend a Fannie Mae loan, knowing that Fannie Mae does have an allowance, for example, to transfer a property into an LLC after closing, but the down payment requirements are different. So it really depends on each person's circumstances. But DSCR is a great solution that's fairly easy to qualify for.
Yeah, so okay, last question. I appreciate this question. I think I know the answer to it, but I'll let you, and then we're gonna wrap this thing up real quick. I have 350,000 to 400K equity in my duplex in Dallas, Texas. It appraised for about $500,000. How much home equity loan can I get from this duplex property?
Generally about 80% is probably the max, depending on the lending program. 75 to 80%, assuming it's an investment property and not a duplex where you live in one unit and rent the other. That would be owner occupied, whole different set of guidelines and requirements for that. So generally speaking, unless you're getting into multi-million-dollar properties, you can generally get up to 75 to 80% leverage on an investment.
Yep.
And that's
Great.
inclusive of your existing mortgage.
Great. Scott, if you want to go to our closing slide. So, hey, that is number 2 of SFR Talk and financing options. Scott, can you flip the slide, please? I appreciate everybody attending today. We will send a recording out to all of the attendees that attended today. We're always here, happy to help you with property management services and any questions you have about that. Mark and his team and their contact information is available there for any financing questions or help that you need. Mark's team is ready to go and able to help you. We will send this out via email to everybody, as well as our contact information. And thank you so much for joining today. Mark, thanks for joining and being part of SFR Talk. Really appreciate you being here, and I hope everybody has a great day.
Thank you. Take care, everyone.
Bye.